America owes $38 trillion in debt. But here's what nobody's telling you. The government is making that debt disappear without paying a single dollar back. They're not cutting spending. They're not raising taxes. They're using a trick called financial repression that silently transfers wealth from savers to the government while erasing the real value of debt. Here's how it works. The Federal Reserve keeps interest rates at 4.5%, while inflation runs at 3% or 4%. That means if you hold government bonds or savings accounts, you're earning maybe 1% real return after inflation, or losing money. But the government? They're paying 4.5% interest on debt that's being eroded by 3 to 4% inflation every year. The real cost of their debt is shrinking. And it's working. After World War II, America reduced debt from 106% of GDP to 30% by the 1970s using this exact strategy. They didn't pay back the debt, they inflated it away. Economists Carmen Reinhart and Kenneth Rogoff documented this in their study, The Liquidation of Government Debt, showing that negative real interest rates erased 3 to 4% of GDP worth of debt annually for decades. Now they're doing it again. The $38 trillion debt that sounds catastrophic today will be worth maybe $25 to $28 trillion in real purchasing power by 2035 if inflation averages 3% annually. The government wins. Bondholders and savers lose. In this video, I'm exposing exactly how financial repression works, why the Fed is deliberately keeping rates below inflation, how America erased 70% of World War II debt using this trick, who profits and who pays for this wealth transfer, and how you can protect yourself before your savings are silently confiscated. But before we expose how America is secretly erasing $38 trillion in debt, if you want to understand how government policy affects your wealth and how to position yourself before financial repression destroys your savings, subscribe to the Investor's Lens. Hit subscribe now. There's one government strategy for eliminating debt that is by far the most effective, and it's happening right now without most people realizing it. It's called financial repression, and it's a deliberate policy of keeping interest rates below the inflation rate to erode the real value of debt. Let me explain how this works in simple terms. Imagine the government owes you $100. 1 year later, with 3% inflation, that $100 only buys $97 worth of goods. The government still owes you $100 in nominal terms, but in real purchasing power terms, they only owe you $97. They've effectively reduced their debt by $3 without paying you anything. Now scale that up to $38 trillion. If inflation runs at 3% for 1 year, the real value of that debt decreases by $14 trillion. Over 10 years at 3% inflation, the $38 trillion debt is worth only $28.2 trillion in today's purchasing power. The government erased nearly $10 trillion in debt simply by allowing inflation to run, but it only works if interest rates don't rise to compensate for inflation. That's where the Federal Reserve comes in. The Fed sets interest rates. If they keep rates at 4.5% while inflation is 3%, bondholders get a 1.5% real return, barely enough to preserve wealth. But if the Fed keeps rates at 3% while inflation is 4%, bondholders get a negative 1% real return. They're losing money even though they think they're earning 3%. This is financial repression, deliberately keeping interest rates below inflation to transfer wealth from savers and bondholders to the government. And the Fed has multiple tools to make this happen. Tool 1. Direct interest rate control. The Fed sets the federal funds rate, which influences all other interest rates in the economy. By keeping this rate artificially low, they suppress returns on savings. Tool 2. Bond purchases. When the Fed buys government bonds, quantitative easing, it increases demand for bonds, which raises their price and lowers their yield. This keeps interest rates low even if markets would naturally demand higher yields. Tool 3. Forward guidance. The Fed announces it will keep rates low for extended periods, which anchors market expectations and prevents investors from demanding higher yields. Tool 4. Banking regulations. Regulations require banks to hold government bonds as safe assets, creating artificial demand that keeps yields low. The result is an entire financial system engineered to keep interest rates below inflation. Now, the Fed doesn't publicly admit they're doing this to erode debt. They say they're keeping rates low to support economic growth or achieve their 2% inflation target. But the effect is the same. Real interest rates stay negative or barely positive, and the real value of government debt shrinks. And there's historical precedent. After World War II, the U.S. had debt at 106% of GDP, higher than today's 122%. By the 1970s, debt fell to 30% of GDP. Only about 30% of that reduction came from paying down debt through budget surpluses. The other 70% came from inflation and negative real interest rates eroding the debt's value. Economists Carmen Reinhart and Maria Bellansprancia documented this in their 2015 study. They found that during 1945-1980, real interest rates in the U.S. were negative roughly half the time. The annual liquidation effect, debt erased through negative real rates, averaged 3 to 4% of GDP per year. Over 35 years, that adds up to massive debt reduction without ever actually paying the money back. And now they're running the same playbook again. But financial repression doesn't just erase debt. It creates winners and losers. This next effect is perhaps the most important because it reveals who profits and who pays when America erases its debt through inflation. It's the wealth transfer from savers to borrowers. And the numbers are staggering. Here's the brutal reality. Financial repression is a hidden tax on anyone who holds cash, bonds, or fixed income assets. Your wealth is being slowly confiscated to pay for government debt reduction. Let me show you the math. If you hold $100,000 in a savings account earning 2% interest and inflation is 3%, you're losing 1% of purchasing power annually. That's $1,000 per year. Over 10 years, you've lost $10,000 in real wealth. Now multiply that across the entire economy. Americans hold approximately $18 trillion in savings accounts, money market funds, and bonds. If real interest rates are negative 1% annually, that's $180 billion in wealth transferred from savers to borrowers, primarily the government, every single year. But it's worse than that. The government doesn't just benefit from negative real rates on existing debt. They also benefit from being able to borrow new money at artificially low rates. The U.S. government pays about $152 trillion annually in interest on $38 trillion in debt, an average rate of about 4%. Without financial repression, market rates might be 6 to 7% given the risk of lending to a government with 122% debt to GDP. At 6%, interest payments would be $2.28 trillion, $760 billion more per year. Financial repression saves the government hundreds of billions annually in interest costs while simultaneously eroding the real value of outstanding debt. Who pays for this? 3 groups: retirees and savers. Anyone holding bonds or cash for retirement sees their purchasing power erode. A retiree with $500,000 in bonds earning 4% thinks they're safe. But after 3% inflation and taxes, their real return is maybe 1 to 2%. Their $500,000 buys less every year. Pension funds. Public and private pensions hold trillions in government bonds. When real returns are negative or barely positive, pension funds can't meet their 7 out of 8% return targets. This creates unfunded liabilities, promises to retirees that can't be kept. The middle class. Wealthy people don't hold much cash or bonds relative to their wealth. They own stocks, real estate, businesses, assets that inflate in value along with money supply. The middle class holds more of their wealth in savings accounts and bond funds that get destroyed by financial repression. Meanwhile, who benefits? The government. They borrow at artificially low rates and watch inflation erode the real value of their debt. Large corporations. They can borrow at low rates and invest in real assets that appreciate with inflation. The ultra-wealthy. They own appreciating assets and can borrow cheaply to buy more assets. There's an academic term for this, the inflation tax. Inflation redistributes wealth from creditors to debtors, from savers to borrowers, from the middle class to the government and wealthy elite. And unlike an explicit tax that requires congressional approval and appears on your tax return, the inflation tax is invisible. Most people don't realize they're paying it. A 2015 IMF study by Reinhardt and Sprancia calculated that during post-financial repression, 1945-1980, the annual wealth transfer averaged 3 to 4% of GDP in the US and UK. In Australia and Italy, where inflation ran higher, the transfer was about 5% of GDP annually. At today's GDP of $28 trillion, a 3% transfer equals $840 billion per year, flowing from savers to the government through negative real interest rates. That's $840 billion annually in wealth confiscation that doesn't appear in any budget document or tax form, and it's completely legal, but the playbook gets even more sophisticated. Here's the historical precedent that proves financial repression works, and it's exactly what America is copying today. It's the post-World War II debt reduction from 1945 to 1980. And the strategy was brilliantly effective at erasing debt while keeping the public unaware. Let me walk you through what happened. In 1945, U.S. debt peaked at 106% of GDP after financing the war. Everyone expected decades of high taxes and austerity to pay it back. Instead, by 1980, debt had fallen to just 30% of GDP, a reduction of 76 percentage points. And here's the shocking part. Only about 20-25 percentage points came from actually paying down debt through budget surpluses. The other 50-plus percentage points came from inflation and negative real interest rates eroding the debt's value. How did they do it? Through a coordinated strategy between the Treasury and Federal Reserve. Step 1. Interest rate caps. From 1945 to 1951, the Fed explicitly capped interest rates on Treasury bonds at 2.5% for long-term bonds and even lower for short-term bills. This was called the PEG policy. Step 2. Forced bond holdings. Banks were required to hold government bonds as reserves. This created artificial demand that kept yields low even after the rate caps ended in 1951. Step 3. Capital controls. Regulations limited how much capital could flow overseas, preventing Americans from escaping low returns by investing abroad. Step 4. Inflation without compensation. Inflation averaged about 4 to 5% during much of this period, but interest rates were kept at 2 and 3%. Real returns were negative, or barely positive for decades. A BlackRock study from 2025 documented this brilliantly. They showed that during 1945-1980, nominal GDP growth consistently exceeded interest rates on government debt. This snowball effect meant that even though the government was running deficits, the debt-to-GDP ratio still fell because GDP was growing faster than debt was accumulating interest. But here's the key insight. GDP was growing faster not because of real economic growth alone, but because of inflation. Nominal GDP growth includes inflation. Real GDP growth was maybe 3%, but nominal GDP growth was 7 or 8% due to inflation. Interest rates at 2 to 3% couldn't keep up with 7 or 8% nominal GDP growth. The gap between interest rates and nominal growth is what eroded the debt. And the public didn't revolt because inflation wasn't hyperinflation. It was a steady dose of 3-5% annually, enough to erode debt, but not enough to cause panic. The Carmen Reinhart study found that during this period, The US had negative real interest rates, interest below inflation, about 50% of the time. The liquidation effect averaged 3 to 4% of GDP annually, which over 35 years equals 140% of GDP in cumulative debt reduction. The World War II debt was essentially inflated away while the government pretended to be fiscally responsible. And here's the scary part for savers. During the 1950s, 1970s, anyone who held government bonds or savings accounts lost purchasing power year after year. They were earning 2 to 3%, while inflation was 4 to 5%. Their wealth was being silently confiscated to reduce government debt. Retirees who thought they were being conservative by holding bonds got destroyed. The wealthy who owned stocks, real estate, and businesses saw their assets appreciate and won. Financial repression worked beautifully for the government, and now they're doing it again. But today's version has some new tools. Here's the 21st century innovation that makes financial repression even more powerful. And it's something that didn't exist after World War II. It's quantitative easing. And it's money printing disguised as monetary policy. Let me explain what QE actually is. The Federal Reserve creates money electronically, literally types numbers into a computer, and uses that newly created money to buy government bonds from banks. From 2008 to 2025, the Fed created approximately $8 trillion through QE programs. That's $8 trillion in money that didn't exist before, created to buy government debt. Here's why this is financial repression on steroids. When the Fed buys bonds, it increases demand, which raises bond prices and lowers yields. This suppresses interest rates across the entire economy. During QE1, QE2, QE3, and pandemic QE, the Fed bought trillions in Treasury bonds and mortgage-backed securities. This kept 10-year Treasury yields at 1.5 to 2.5% even when inflation was rising. Without Fed intervention, bond yields would have been much higher. Investors would demand 5 to 6% to lend to a government with massive debt. But the Fed artificially suppressed yields by being the buyer of last resort. And here's the wealth transfer. The Fed holds $4.8 trillion in Treasury bonds bought with created money. The government pays interest on those bonds to the Fed, but the Fed remits most of that interest back to the Treasury after expenses. So the government is essentially paying interest to itself. It's a circular flow where newly created money finances government spending, and the interest payments loop back. Meanwhile, savers and bondholders who aren't the Fed earn suppressed yields on their investments. They're the ones losing purchasing power. The technical term for this is debt monetization, creating money to finance government spending. It's prohibited in many countries specifically because it leads to inflation and currency debasement. But in the US, there's a loophole. The Fed can't directly buy bonds from the Treasury. That would be obvious money printing. But they can buy bonds from banks who just bought them from the Treasury. It's indirect monetization. Functionally identical but technically legal. And the effects are the same. The money supply increases, inflation rises, and the real value of debt erodes. A 2022 Oxford study on inflation and debt consolidation found that quantitative easing combined with financial repression can reduce debt by 18.7% of GDP over a decade, far more than either strategy alone. The modern playbook is more sophisticated than the 1950s version. Instead of explicit interest rate caps, we have QE suppressing yields. Instead of forced bond holdings, we have banking regulations incentivizing government debt. Instead of capital controls, we have a global monetary system that makes it difficult to escape dollar-based assets. But the goal is identical. Keep interest rates below inflation and erode the real value of debt while transferring wealth from savers to the government. So how do you protect yourself? Here's exactly how to position yourself before financial repression destroys your savings. Strategy 1. Own real assets. Financial repression destroys the value of cash and bonds but preserves the value of real assets. Stocks, real estate, commodities, precious metals all appreciate in nominal terms as inflation rises. This is why the wealthy own assets, not cash. They understand inflation protection. Strategy 2. Minimize bond holdings. Government bonds and bond funds are death traps during financial repression. You're earning 4% while inflation is 3 to 4% and taxes take another 1%. Real return is 0 or negative. Avoid long-term bonds especially. If inflation accelerates, long-term bond prices will crash. Strategy 3. Own inflation beneficiaries companies that thrive during inflation. Commodities producers, oil, mining, banks that can raise lending rates, real estate investment trusts, infrastructure companies with pricing power. Strategy 4. Precious metals. Hedge gold and silver, protect against currency debasement. When governments inflate away debt, precious metals preserve purchasing power. Consider 5 to 10% portfolio allocation. Strategy 5. Dividend-paying stocks. Companies that pay growing dividends provide income that rises with inflation. Unlike fixed bond coupons, dividends can increase. Strategy 6. Understand the game. Financial repression is a wealth transfer from savers to borrowers. Position yourself as a borrower. Own appreciating assets financed with cheap debt, rather than a saver, holding depreciating cash and bonds. Strategy 7. Geographic diversification. Don't keep everything in dollar-denominated assets. Consider international assets, especially in countries not running financial repression. The bottom line? America is erasing $38 trillion in debt by inflating it away. Either own assets that inflate with it, or watch your wealth disappear. So we've exposed how America is silently erasing $38 trillion in debt. The financial repression playbook of keeping interest rates below inflation to erode debt's real value. The wealth transfer mechanism, stealing $840 billion annually from savers through the inflation tax, the Post-WWII blueprint that reduced debt from 106% to 30% of GDP by inflating it away over 35 years. The modern quantitative easing twist that suppresses yields while creating $8 trillion in new money. And exactly how to protect your wealth by owning real assets instead of cash and bonds. These are the government strategies that school never taught and financial advisors rarely mention. But here's something I didn't tell you at the start of this video. Everything I just shared is completely useless if you don't know which specific assets will outperform during the next phase of financial repression, which currencies might collapse first, and which countries offer the best protection from inflation. Without this knowledge, you'll pick the wrong assets and still lose money. Comment under this video and I will reveal the 7 best inflation-proof investments for 2026 and how to build a portfolio that thrives during financial repression. I'll see you in the next one.